Hello everyone, this is Sebastian McMahon from IA Financial Group, and this is the weekly review for the week ending January 26th, 2024. So let's start with a look at the markets at the close on Thursday. So we were expecting some volatility to start the year. This is what we have. Volatility can be negative or positive. This week it's positive. Remember how we ended 2023. Markets had a strong run, interest rates down, stock market up to end the year as more and more rate cuts were expected for 2024. Now it's kind of maybe a time of reckoning. Markets are repricing everything, and the volatility that we have from that right now is supporting stocks, negative for bonds, but we do expect that animal spirit or sentiment will be leading the way for the next few weeks and months given this environment. The USD was strong on the week, pushing the CAD, Euro, and gold lower. Price of oil higher. We're seeing a bit of a rebound from very low levels to start the year, at least based on the history of a few years. So this week's story is the Bank of Canada. So Bank of Canada holds but shifts towards when to cut. And here what I brought was a few excerpts from the press conference opening statement, and I think everything that you need to know is there. First, there was a clear consensus to maintain our policy rate at 5%. So Mr. McClem said that. So it's very important because he says 5% rather than at the actual levels or around current levels. So it's 5%. That means that we're not getting higher. This is the message here. So rate cuts are over. So that's, we've been discussing that, we've been expecting that for a while, but now it's becoming more clear from the Bank of Canada. The second statement is very important. The Governing Council is discussing future policy. The discussion about future policy shifting from whether monetary policy is restrictive enough to how long to maintain the current restrictive stance. So the question is, when should they start cutting? And it's not here in this excerpt, but they did also mention that they expect inflation to be sticky at 3% for the first half of the year and then start coming down. So it's kind of hinting that rate cuts are coming somewhere around the summer. So it's kind of the scenario that we had, but we did have this date circled because we thought it was necessary for the Bank of Canada to start to set the table for the dynamics of the rate cuts that are expected in 2024. And what it smells like right now is that we'll have cuts starting around the summer. We think that July is most likely because we'll have a full meeting with the monetary policy report, a press conference by Mr. McClem. But, markets are pressing odds that it's in June that we'll get started. So, around the summer, we'll have a start. And then after that, depending on how the macro data evolves, maybe we'll have 2 cuts, 3 or 4, because there's 4 meetings on the back end of the year. It's all possibilities. Those are all possibilities, but let's see how the data evolves. After that, 2025, and if maybe we move to the next slide here, the forecasts from the Bank of Canada. We told you last week that the table on the left was the one to watch, and expectations for, at least forecasts for inflation by the end of 2024 and 2025 by the Bank of Canada were revised overall lower. So we went from 2.5 at the end of this year to 2.4. So it's kind of in the margin of error here, but still the signal is that they're pretty confident that inflation will be coming down. So that means that there's more hints here that they're comfortable to work on the plan to start cutting. And on the right, it's a very important chart that maybe doesn't look like much here, but they did a study of housing and its impact on inflation. And they looked at the strong inflation that we saw over the last few years. Some of that was from the cost of materials to build housing. Some of that was because of demographic flows. So, of course, more people coming in, pushing rents higher, pushing housing prices higher. Of course, when you raise interest rates, mortgage rates go higher. And since the cost of servicing your mortgage is a very important part of your spending, it goes into the calculation of the CPI. So again, the paradoxical effect that higher rates by the central bank is creating some inflation. No, the bank is studied that, and they just split the effects into here. And what it shows on this chart here is that the things that the Bank of Canada doesn't really have control on with its leading rate, are explaining about half of the inflation that's coming ahead. And this is all in housing. So the demographic growth is pushing housing prices higher. So Bank of Canada cannot do anything with that, with its leading rate. Rents are rising because population growth is strong. You don't address that with monetary policy. And also you kind of need to look through the impact of your higher rates on mortgage costs, because we get into like an infinite loop then. So if you split the two, the bank shows that about only 1% of the 2% inflation that's expected is the real thing that they're targeting here. So that leads them to be likely much more comfortable to start cutting, because when you look at how inflation is built, you need to address the right parts, and the parts that the bank addresses with its monetary policy are showing enough progress to start moving. So that was a very important analysis on their part to split the impact of housing on total inflation. And if you focus on the right segments, it's clear now that it's time for the bank to start acting. So cuts starting mid-year, between 2 and 4 by the end of this year. After that, more cuts in 2025 and into early 2026, where eventually we go back to neutral, which is, according to the Bank of Canada's estimates, about 2.5%. So it's going to be a slow path, but still the path to cutting monetary policy rates is getting much clearer here. So market pricing at the beginning of the year, if you look on the chart on the left, the bottom line, the dark blue one, markets were pricing 6 cuts when we started the year. Now we're at between 4 and 5, so we depriced close to 2 cuts already, explaining the higher interest rates and the negative performance of bonds so far this year. This will continue to be volatile over the next few months, depending on the macro data that comes out, what the Bank of Canada says. But this is where we can see a source of volatility. And on the right also, there's the quantitative tightening, or the size of the balance sheet. If you look at the gray line, it's as a percentage of GDP. Now we're down to about 11%. The Bank of Canada is of course cognition that you don't want to squeeze liquidity too much, and there's kind of this consensus that's emerging that in April likely quantitative tightening will be stopping in Canada. So that's one more restrictive policy measure that could be ending. So we're really moving towards steady easing in monetary policy in 2024, which is of course good news. So China now, $6 trillion market route. So that's quite a route that we've seen there, and the PBOC is to the rescue. It's important to understand that the Chinese stock market is dominated by retail investors. So when you have something like that happening, it can cause some social unrest, and on the political level, it's something that you don't want to just leave unaddressed. You want to act on this if you're the Chinese government, and we've heard Mr. Jinping opine on that. And here you've seen the premier ordering measures, and we got some measures, and it's interesting because it's the PBOC that's cutting the required reserve ratio of banks to jolt to the market. So far this week it seems to be working, but let's give it some time. But interestingly, usually the PBOC, when they make these kinds of measures, they just announce them on the morning and it's done. But now they telegraphed it that it's coming in early February. It kind of shows the sense of urgency that we're seeing here. So the Chinese stock market remains under pressure here. Momentum is very negative. Of course, the outlook for economic data in China is pessimistic. We hear that Chinese investors are looking at opportunities elsewhere outside of the country. So it's not a good story right now for China. So if you want to invest there, prudence might be a good measure. But still, if we start to see that these measures make sense and we make a base, could be eventually a very good market to take a look at. So that's it for China. So what to watch next week? In Canada, we'll have the Bloomberg Nanos Confidence Index, the GDP growth figures for November, and the S&P Global Canada Manufacturing PMI. In the US, it's a big week with the Conference Board Consumer Confidence Index, the JOLT jobs opening reports, Fed rate decision, no change, but the language again is important, could cause some volatility if markets like what they hear too much or not at all. So we'll see next week. ISM manufacturing should still point to contracting sectors, so below 50. Non-farm payrolls should continue to slow down, but still positive number at 168,000. And unemployment rate is expected to jump from 3.7 to 3.8%. So that wraps it up for the week. ia.ca/economy for the review for the podcast. iagam.ca/insights for the monthly, for the weekly commentary. There's ample material for everyone. Thank you for following us, and I'll be back again next week.